If you come across liquidity pools and yield farming, you must have heard about impermanent losses. But what is it and how does it affect your crypto investment? You will find out if you continue to watch this video. Impermanent loss in a liquidity pool occurs when the price of a crypto token goes up or goes low after it has been deposited in the liquidity pool. The change in the price of the crypto token is considered a potential loss, especially when the value of your crypto token in dollars at the time of withdrawing it is less than the value when you deposited it into the pool. This kind of loss is very common with yield farming, a kind of crypto investment where you stake or lock up your crypto in pools to earn rewards for that. Although yield farming sounds almost like staking, it's not the same. It's a lot more complex. Fortunately for you, we have a video that simplifies the whole process for you. Welcome to our channel, where you learn about crypto terminologies in a very easy way. In today's video, we will talk about impermanent loss and its relationship with liquidity pools and yield farming. In yield farming, you stake or lock up your crypto in a liquidity pool where people can trade from, borrow from, or exchange their crypto assets. For doing that, you earn rewards that differ in value and worth based on the protocols concerned. Yield farming is considered a more lucrative crypto investment than just holding your crypto. But when you provide liquidity with it, there are certain risks you should expect. One such risk is impermanent loss, although there is risk associated with the volatile nature of crypto you should be worried about. The risk of impermanent loss can either be high or low, depending on the crypto tokens in the liquidity pool and the number of users providing liquidity. In the liquidity pool, tokens are paired with others. It's always a pair between a stablecoin or an Ethereum-based crypto token. An example is the Ethereum and DAI liquidity pool, or the Ethereum and Sushi liquidity pool. The more stable a coin is, the less the risk of an impermanent loss. Like we were saying, the difference in the dollar value of depositing your crypto to the liquidity pool and that of when withdrawing it is an impermanent loss. Luckily, it can be cancelled. That occurs when the price of the crypto at the deposit is the same as when it was withdrawn. But if there is an impermanent loss and you go ahead to withdraw your token, the loss becomes permanent. Does this mean you can't avoid impermanent loss? No, impermanent loss can't be avoided altogether, but it can be reduced. But to not feel the weight of the loss, there are incentives given by the protocol, and there's also a reward you get from trading fees. These two can help mitigate it, but these are not the only ways. You can find out more after these examples of impermanent loss, which will help you understand how they work. So let's take, for instance, Mr. A is a crypto investor who puts his crypto investment in an Ethereum and US dollar coin liquidity pool. The tokens in the pool are of equal ratio, and one Ether in the pool has a value of $100, while the US dollar coin is worth $1. Mr. A, the liquidity provider, needs to add one of his Ether and 100 of his US dollar coins to the liquidity pool, making his total investment a value of $200. If the liquidity pool has 1,000 US dollar coins in the liquidity pool, then it must have 10 Ethers as well. Apparently, Mr. A has 10% of the liquidity pool. You should know that the prices of each token in the pool are dependent on the ratio of tokens in the pool. And most times, it is very different from the prices on decentralized crypto exchanges. This is all thanks to automated market makers. Back to Mr. A's investment. If the price of the Ethereum increases by 100%, then one Ether would be $200 instead of $100. But since the pool has to maintain the ratio, the Ether in the pool would only be about 7.07, while the US dollar coin would be at 1,414.2. If Mr. A chooses to withdraw from the liquidity pool, he will receive 141.42 US dollar coins, which is worth $141.42, and 0.7071 Ether worth the same price, making his total withdrawal $282. An $82 gain is not bad, right? Well, true, it's not. But something is wrong. If Mr. A had chosen to just hold on to his crypto, he would have had $300 worth of crypto tokens. The $18 difference is the impermanent loss. It might look small now, but a wider change in the difference would result in a larger loss. Another example before we look at how you can avoid impermanent loss and not be in Mr. A's situation. Say Mr. A tells his friend Mr. B that he ventured into liquidity pool farming and has made quite an impressive gain from it. Mr. B is intrigued and wants to try it out too. But to avoid the $18 impermanent loss Mr. A experienced, he went for another kind of liquidity pool, an Ethereum and DAI liquidity pool, and he also stepped up because he needed more rewards. So Mr. B deposits 2 Ether and 200 DAI. Remember that the automated market maker sets the price, and each of the tokens has to be of equal value. That means the price of one of Mr. B's Ether is equal to 100 DAI, and 100 DAI equals $100, making Mr. B's total investment $400. Mr. B is not the only crypto investor in the liquidity pool. There are others, and together the pool has a total of 10 Ethers and 2,000 DAI, making 20% of the pool Mr. B's share. Along the line, like in Mr. A's case, Ethereum went up by 100% from $200 to $400, thus creating investment opportunities for crypto investors known as arbitrage traders who will remove Ethereum from the pool and add DAI to it until the price is reflected by the ratio. Don't forget that in automated market makers, prices are set by ratios of tokens in the pool and not by the market, especially since market makers do not operate order books. Now, while the liquidity in the pool containing Mr. B's investment stays constant, the rate of the tokens changes. So, in the pool, there will be 5 Ethers and 2,000 DAI. Remember that Mr. B has 20% of the liquidity. If Mr. B decides to pull out from the liquidity pool, he would have 1 Ether and 400 DAI, making his total return $800, $400 more as gain. Sounds interesting? It might sound disappointing if you compare it to a scenario where Mr. B never put his crypto into the pool at all. His 2 Ethers would have been $800, plus the 200 DAI, that's $1,000. So he lost $200. This difference is called impermanent loss, and $200 is a lot of money to lose. However, some situations can negate impermanent loss and make it more bearable, or make it all disappear. Remember, in both Mr. A and Mr. B's investments, we didn't include the rewards they could have gotten because of the transaction in the pool. These trading fees can go high enough that they negate the loss, especially when the trading volumes of the token soar. That aside, there are things you can do to reduce your risks of encountering impermanent loss. The most important thing is to look for crypto tokens which are pairs of stablecoins. From their name, they are both stable and are not exposed to the risk of volatility common in the crypto world. An example of a liquidity pool that offers stablecoin pairs is the US dollar coin and the US dollar token pool. Although there will not be much increase in price between the 2 crypto tokens, you'll still benefit from the trading fees. Another way you can reduce impermanent losses is to split your crypto investment into 2. How is that possible? Simple. You just break your crypto assets into 2 parts. While you put one in a liquidity pool to rake in profits from trading fees, you hold the other parts. So even if there is going to be an impermanent loss, you have successfully slashed it by 50%, saving yourself the trauma of losing crypto. But there's a downside to it. Once you slash your crypto investment, you have also slashed the potential rewards you would have gotten from a full investment. Talk about not being able to eat your cake and have it back. To also avoid impermanent losses, you need to stay away from volatile crypto token pairs. Stick with stablecoins if you can, but avoid pairs where one crypto token seems like it will do better than the other token. This is very bad for business. But if the prices of the 2 tokens might rise and fall at the same time, it's better, and you can go for it. Ultimately, you need thorough research before you can proceed. You can also look out for liquidity pools with uneven asset ratios, which can help to reduce impermanent losses. Then there is the fact that you could also do liquidity mining, where you get liquidity pool tokens in the blockchain's native currency. You must factor in all these rewards and incentives and weigh them against a potential impermanent loss before deciding liquidity pool or yield farming is not something you can do. For more information on what liquidity pools are or what yield farming is, check out these 2 amazing and simple videos. Hey, there are more where this came from. To stay connected, don't forget to subscribe. Till the next video, goodbye!